Today, we're doing a deep dive analysis into the profound transformation that's happening in China's automotive retail sector. What we're seeing isn't just a cyclical downturn, it's a fundamental structural reshaping of the entire value chain.
So let's start with our conclusion first. Our core thesis is this: China's auto dealership industry is not collapsing. Instead, it's undergoing what we call a binary differentiation. The traditional profit model is, quite simply, broken beyond repair. And this breakdown is creating a very clear divide, shifting the entire industry's focus away from just selling cars to dominating a long-term service ecosystem.
We've structured our analysis into 5 parts to really unpack this. We'll start with the endgame, this binary differentiation. Then, we'll walk through the data that proves the old model's collapse. After that, we'll look at the new cornerstones of profit, analyze what makes China's transformation so unique, and finally, we'll talk about what it takes to capture value in this new landscape.
Okay, first, it is absolutely crucial to understand where this industry is heading. We're looking at a future defined by 2 very different kinds of companies.
And we're calling this binary differentiation. You can think of it as a great split that's dividing the market in 2. On one side, you have these well-capitalized, operationally sharp groups that are successfully turning themselves into service platforms. And on the other side, you've got the capital-starved dealers who are stuck with legacy assets that are quickly becoming obsolete. This split, this is the single most important dynamic to understand right now.
Now let's examine the evidence. The data that's driving this differentiation paints an incredibly clear picture. There's really no ambiguity here.
The very foundation of the old dealership model, making money from new car sales, hasn't just gotten weaker, it's completely crumbled. What used to be the main profit center has now become a massive structural money loser.
And just look at this data point. Zhongsheng Group, a market leader, a benchmark for the industry, reported a negative 2.6% gross margin on new car sales for 2024. To put that in perspective, that's a gross loss on over 125 billion RMB in revenue. It just perfectly highlights how severe this collapse is.
And this isn't just a one-company problem. It's systemic. Our analysis for the first half of 2025 shows that the entire listed dealer sector booked an average net profit margin of negative 2%. The industry as a whole is now unprofitable.
So what's causing this? Well, it's a phenomenon known as price inversion. It's a situation where dealers are literally forced to sell cars for less than they pay the manufacturer. And I have to stress, this is not a temporary dip. It is a permanent shift, and it's being driven by chronic overcapacity and absolutely brutal price wars.
Okay, so if the old model is broken, it's only logical that a new profit foundation has to emerge, one that's built on completely different pillars. This chart really tells the story. It shows a complete flip in the profit structure. The high-margin businesses, specifically after-sales and finance, now account for all of the gross profit. And here's the crucial part. They are now actively subsidizing the losses that are coming from selling new cars.
This forces a massive strategic pivot towards what we're calling the new 3 horses: after sales, finance, and used cars. The whole goal of the business shifts. It's no longer about making a one-time profit on a sale. It's about acquiring a customer for a long-term, high-margin service relationship. A new car sale is now effectively the cost of customer acquisition.
And this table lays out the strategic trade-offs pretty clearly. The traditional 4S model, it has huge inventory risk, but it keeps control over those lucrative services. The direct-to-consumer model, on the other hand, gets rid of that inventory risk, but it requires an enormous amount of capital from the manufacturer to even work. And the agency model has sort of emerged as a middle ground, letting dealers work with new brands without taking on all that inventory risk.
Now, while consolidation is a global trend, it's really important to understand that the speed and the nature of China's transition are in a class of their own.
The biggest difference here is the sheer speed of the new energy vehicle transition. As of 2025, China's NEV penetration rate blew past the 50% mark. I mean, that pace just completely dwarfs other major markets. It's like a decade of structural change compressed into just a few years.
And this creates a huge difference in strategic urgency. In the US, dealers can still make a profit selling new cars, which gives them a financial cushion. But in China, dealers are facing structural losses. For them, pivoting to services isn't just a good idea, it is a matter of survival.
So, as this comparison shows, China's market is just structurally different.
It's defined by a much more complex mix of sales channels and, importantly, a much stronger role for government policy in shaping how the market evolves. That's pretty different from the consumer or regulation-driven changes we see elsewhere.
So, given this whole context, our analysis has identified the key attributes that are going to define the survivors and the primary value creators in this new era.
The winners here are not just car sellers anymore. They're evolving into large-scale service platforms. And the blueprint for survival is becoming very clear. You need a rock-solid balance sheet, a portfolio of premium brands that have strong service demand, proven partnerships with the leading NEV players, and, maybe most importantly, superior operational excellence.
Operational metrics like inventory management have become absolutely critical signs of resilience. Take Zhongshan, for example. Their ability to keep inventory turnover stable, even in this chaos, just shows a level of risk control and management discipline that really separates the leaders from the rest of the pack.
So, where will future growth come from? Our analysis points to three clear engines. First, capturing the new high-margin NEV after-sales market. Second, tapping into the newly opened channel of used car exports. And third, consolidating smaller competitors in lower-tier cities, which is where EV growth is now accelerating.
And we're already seeing the data to back this up. Look at Yangda Auto. Their new energy vehicle maintenance revenue surged by almost 76%. This isn't just a theory, it's happening right now, and it's creating an entirely new and very lucrative service economy.
Which leads us to the central question that's going to define this industry's future. As the old sales-focused model fades away, the critical question becomes, which of these surviving companies has the right strategy, the capital, and the operational chops to build the dominant service empires of the new automotive era?